The U.S. tax code is roughly 7,000 pages long. Most people think that means it is 7,000 pages of punishment. It is not. Only a tiny fraction of it is really about calculating what you owe. The rest of it is instructions, incentives, signals. It is the government telling you in a language most people never bother to learn what it wants built and who it is willing to reward for building it. Housing, energy, infrastructure, technology, domestic production. The list changes a little with politics, but the mechanism stays almost the same. The government cannot create these things on its own. It cannot produce real wealth by decree. It cannot build enough homes by itself. It cannot drill enough oil. It cannot deploy enough energy infrastructure. It cannot launch enough companies or create enough GDP by waving a memo around in Washington. It needs other people to do it. It needs citizens. It needs operators. It needs investors. So it uses the tax code to point capital in that direction. That is the part most people miss because they are reading their taxes through the wrong lens. The average person looks at a tax bill and sees a bill. An investor looks at the tax code and sees a map. That is the difference. This is not about gray area loopholes. It is not about some black box scheme rich people whisper to each other in a private room. It is not illegal. It is not hidden. It is published policy. The government is saying something very simple. If you put money into the things we want more of, we will help you do it. Maybe we will not tax you on part of that income. Maybe we will let you depreciate the asset. Maybe we will give you a credit. Maybe we will let you accelerate all of it into year one. Maybe we will do more than one of those things at the same time. That is not a trick. That is the design. And yet most people never use it because most people stay on what I would call the consumer path. That path is painfully familiar. You go to school, you get the degree, you get the job, you earn the income, the taxes come off the top, then you live on what is left. If you are disciplined, maybe you save a little. If you are very disciplined, maybe you invest some of that after-tax money and hope compounding will do its work before inflation. Bad luck and lifestyle creep do theirs. That is the default track. But the tax code was not really written to reward that track. The consumer path gets taxed first and lives second. The owner path lives in a different order. The owner or investor path puts capital into the things the government wants funded. And when you do that, the tax code stops acting like a toll booth and starts acting more like a partner. Not a generous partner, not a moral partner, a self-interested one. The government is saying, if you help create what we need, we will make the math easier for you. That is why owners and investors read the code differently. They are not looking only for how much they owe. They are looking for what the code is trying to get them to do. Now, before I get into the 4 specific plays the source lays out, you need to understand the mechanism that makes all 4 of them work, because this is where a lot of people get confused. They hear the word write-off and think they understand the game. Most do not. A write-off, in the ordinary sense, is not very exciting. If your business spends $1 on a legitimate expense, then yes, you do not pay tax on that $1 of income because the expense reduced your profit. Fine, that is useful, but you still spent the $1. That is not what we are chasing here. I am not interested in spending $1 just to avoid paying tax on $1. That is small thinking. What I want is something much better. I want to put capital into an asset, get rewarded by the tax system for doing it, and still own the asset afterward. That is a completely different game. And that game revolves around 2 tools, depreciation and tax credits. Depreciation is one of the most powerful concepts in the whole code if you understand it properly. The government knows that certain productive assets wear out, get replaced, or lose useful life over time. Equipment, real estate components, energy infrastructure, technology hardware, certain production assets. So it lets you treat part of that asset value as a deductible economic cost. In many cases, especially in the United States, the code will even let you accelerate that process through bonus depreciation and take a large amount, or in some cases, essentially all of the depreciation benefit up front in year 1, instead of slowly over many years. That is where things start getting interesting, because now you are not just slowly easing your tax burden, you are compressing a lot of the tax value into the beginning of the investment. And then there are tax credits. A tax credit is even more powerful than a deduction because it is much closer to a 1-for-1 offset against what you owe. If a deduction lowers taxable income, a credit lowers the actual tax bill itself. That distinction matters a lot. Now, if you stop there, the whole thing is already useful. But the source adds the real accelerator. Other people, as money, borrowed money, financed money, lines of credit, asset-backed leverage. This is where the strategy stops being a nice little tax trick and becomes something much larger. because the code, in many cases, does not care whether you paid cash for the asset or used financing to acquire it. If you buy or place into service a qualifying asset, you may be entitled to depreciate the full purchase price even if much or all of that purchase was financed. That changes everything, because now the goal is no longer simply to spend your own money wisely. The goal becomes using financing to acquire a productive asset, taking the depreciation or credit benefits against current tax liability, and letting those tax savings help carry or even substantially fund the investment itself. That is what people mean when they say the government is paying you to invest. It is not mailing you free money for existing. It is letting you redirect money that would have gone to taxes into productive assets the government wants built. That is a massive difference in long-term compounding. If you think like a consumer, the refund is a pleasant surprise. If you think like an investor, the refund becomes fuel. And once you start cycling that fuel back into more productive assets, the whole system begins to compound in a completely different way. That is the foundation. Now, let me walk through the 4 plays the source uses because they all sit on top of this same structure. The first one is Bitcoin mining. Now, whether someone likes Bitcoin or not is not really the point here. The point is the mechanism. If you buy Bitcoin miners, what are you really buying? You are buying equipment. Physical computing hardware that matters, because equipment qualifies as equipment under the code. And under the framework the source is describing, those miners qualify for bonus depreciation, which means the buyer may be able to take essentially the full depreciation in year 1. Think about what that means in practical terms. Suppose you have a large amount of taxable income this year, maybe $150,000, maybe $500,000, maybe more. Instead of simply paying tax on that income and moving on with your life, you acquire qualifying mining equipment. Under the right structure, the depreciation from that equipment offsets the income. But here is the elegant part: you still own the miners. So you did not just erase tax, you converted what would have gone to tax into a productive asset. And what does the productive asset do? It mines Bitcoin every day. That is why the source likes this so much. It is not just tax relief, it is tax relief plus asset creation plus ongoing production. That is the flywheel. The government lets you depreciate the hardware because it is qualifying equipment. The hardware produces Bitcoin. The Bitcoin itself becomes an asset you can hold, sell, or borrow against later. Then the next cycle begins again. The source says this is its favorite play because it likes the idea of the government effectively funding the acquisition of miners. And then the miners funding more Bitcoin exposure later. That is the loop. Now, of course, it is not riskless. You still have Bitcoin price risk, you still have mining difficulty risk, you still have operational risk, you still have financing risk if you structured it with borrowed money. But the reason the strategy is attractive is not because it lacks risk. It is attractive because if you are going to take that risk anyway, the tax code can make the entry dramatically more favorable. That is a completely different game from simply buying Bitcoin after tax with whatever happens to be left over. Now, the second play is real estate. This one is older, more familiar, and in some ways easier for people to understand because real estate depreciation has been part of the wealthy playbook for a very long time. The standard version is slow. Residential real estate gets depreciated over 27.5 years. That works fine if you own a lot of real estate or a very large portfolio. But for a lot of people, that is too slow to create the kind of front-loaded tax effect they are looking for. So the source takes the more aggressive route, cost segregation. That means hiring specialists to break the property into components, carpets, fixtures, appliances, certain improvements, landscaping elements, and other shorter life assets, then reclassifying those into schedules that can be depreciated much faster. Once you do that, bonus depreciation can allow a large chunk of that front-loaded depreciation to hit in year 1 instead of decades later. Now, this is where the source adds an important practical point. You are depreciating the building, not the land. That means the best candidates are properties where a large share of the value is actually in the structure rather than the dirt underneath it. That is a big distinction. A market with huge land value and modest building value gives you less depreciation leverage than a market where the physical improvement is the dominant part of the purchase price, and then the source goes one step further into what it personally prefers: short-term rentals and experiential properties, not just plain vanilla rentals, trophy properties. Scarce properties, unique properties that can command higher nightly income and under the right use and structure potentially fit within rules that make the depreciation more usable even for someone with W-2 income. That is an important nuance. For many ordinary long-term rentals, passive activity loss limits can make using the depreciation trickier for a pure W-2 earner unless other conditions are met. But certain short-term rental structures can create more flexibility. So here again, what is the actual game? You buy the property, you use financing, you seg the building, you accelerate the depreciation. The tax savings effectively help fund the down payment or carry the acquisition. And then you still own the property, which can go up in value and generate rental income. That is why the source likes this category so much. You are not just reducing taxes, you are redirecting taxes into an appreciating or income-producing asset. That is the whole difference between investor thinking and consumer thinking. Now the third play is oil and gas. This one is not fashionable in polite conversation, but it has been one of the classic tax-advantaged investment categories for decades. Why? Because a large portion of oil and gas development expense can be classified as intangible drilling costs, labor fuel site preparation, operational development costs, under the right structure. Much of that can be deducted immediately in year one. That is powerful, because just like the other examples, the goal is not merely to reduce a tax bill. The goal is to use the deduction to help acquire a producing asset. If you invest into a drilling program and a large portion of that investment is currently deductible, then part of the government's tax system is effectively subsidizing your entry into the project. And what do you own afterward? An interest in an energy-producing asset. If the well performs, royalty distributions start coming in. So once again, the pattern is the same: depreciation or deduction up front. Asset ownership afterward. Cash flow if the asset performs. This is why the source says it used this play many times, even if it prefers Bitcoin mining and trophy real estate more. Right now, the specific preference can change with the cycle, energy prices, administration policy, risk appetite, but the tax architecture remains, and under a pro-energy political environment, it is not hard to understand why oil and gas incentives remain very relevant. Now let us come to the fourth play, solar. This one is especially interesting because it combines both depreciation and tax credits. That is where things can get very attractive. The source says that with solar, you may be able to receive a 30% tax credit and then depreciate much of the remaining system value on top of that. That is a very strong combination because, as I said earlier, a tax credit is better than a deduction. It is much closer to a direct offset against tax owed. So imagine a $100,000 qualifying system. The credit alone might be $30,000. Then depreciation could apply to much of the remainder. And now you are not talking about a cute little write-off anymore. You are talking about getting a huge percentage of the project value back through the tax structure in year one before the system has even started generating a dollar of electricity revenue. That is why the source frames it as the government being desperate to fund this category. Because that is exactly what incentives this rich mean. The government is telling capital in neon lights, please build more of this. Again, this is not a loophole. It is industrial policy written into tax treatment. And if the system then generates energy revenue or cost savings over 20 years, even better. The tax system helped fund the acquisition, and the asset itself still exists afterward. Now, I want to zoom out for a moment because the real power here is not any one of these four plays in isolation. It is what happens when you treat them as a compounding loop instead of one-off transactions. That is the part the source cares about most. Suppose you use depreciation or credits to reduce a major tax bill this year. Instead of spending the savings on lifestyle, a car, a trip, or a bigger house payment, you recycle it into the next productive asset. Now the asset base is larger, the income base is larger, the depreciation opportunity next year can be larger. The refund or tax offset can be larger, then you recycle that again. This is how wealth systems start behaving differently from wage systems. In a wage system, you earn, get taxed, and try to save what survives. In a tax-advantaged investor system, the tax bill itself becomes part of the compounding engine. That is what the source means when it says it built much of its wealth this way. Not because the income changed completely every year, because the path the money took changed, same earnings, different route, different result. That is why I always tell people that incentives matter as much as effort. You can work just as hard and end up in radically different financial places depending on whether your capital is flowing through a consumer loop or an owner loop. And the source is very blunt about this. Consumers see the tax bill, owners see the roadmap. That line is worth remembering because nothing in this file is hidden. Bitcoin mining depreciation. Cost segregation on real estate, intangible drilling costs in oil and gas, solar credits and depreciation. All of it is published. The only difference is whether you are reading the code as someone being processed by it or as someone trying to work with it. Now, to be fair, none of this means that everyone should rush out tomorrow and buy miners a short-term rental, an oil partnership, and a solar project all at once. That would be stupid. Tax strategy cannot rescue a bad asset. That is another place people get carried away. A wonderful tax deduction on a terrible investment is still a terrible investment. The underlying deal still matters. The operator matters. The financing terms matter. The asset quality matters. The execution matters. The liquidity matters. And there are also important structural and tax nuances that differ depending on whether you are a W-2 employee, a business owner, a real estate professional, whether you have passive income, whether you materially participate, what state you live in, and how the deal is actually set up. So this is not something to do casually or sloppily, but that does not change the main point. The main point is that the tax code is constantly telling you what the government wants more of, and if you put your money into those categories intelligently, the government often helps fund the process. So the practical action is exactly what the source says. First, know your taxable income, not your gross income, your taxable income. How much are you actually going to send away this year if you do nothing differently? Then ask the real question. If I redirected some of that into a productive, tax-favored asset, what would I still own afterward? Not just what would I save, what would I own? That is the investor question, and then ask the compounding question. If the tax savings were reinvested every year instead of consumed, what does that become in 10 years, in 20, in 30? That is how you begin to see the difference between a tax bill and a wealth system. The government is not trying to reward you for being clever. It is trying to reward behavior it wants more of, build this, fund that, create that, produce that. If you are willing to follow the instructions, the code can work with you. Most people never do. That is why the opportunity persists. The instructions were there all along. They just never read them.